Okay, so good evening, everyone. I hope you guys are preparing hard for your exams. They are really close. So tonight, we'll just revise some key standards, key issues, basically just to give you an overview of, of a lot of things that we have looked at for this diet. And if you also have any other thing that you want from me within the final weeks of the exam, you can also request for that. So I've shared this material to most of you, and is a summarized material for everything, everything I've taught so far on financial reporting. And I've even informed those doing SBR to also join, because everything you're learning in financial reporting is an assumed knowledge for FR. So you definitely are going to be seeing them in your exams, and we could not even teach most of the things again for SBR, because where's the time? So the only topic that I've not really discussed with all of you, but which I would definitely do in is something we'll definitely do, which is the new introduction in IFRS 18. So I'm just being very careful, because IFRS 18 is going to become effective in 2027, right? In 2027. So this is 2025. So even ICAN will not start asking you questions on IFRS 18. No, it's still going to be IS 1. Yes, we expect companies to be getting prepared for the new ways of presenting reports, but it becomes effective in 2027. So I would definitely discuss, I would discuss IS 1, normal, which will be, you guys will be very familiar with it. And I will just give you a few summaries here and there, very few key points, what IFRS 18 is bringing on board, the benefit, the key changes. So it will be very short, very summarized. So be sure that you're going to have that. But not that I'm going to say, okay, this is what you're going to find in your exams, that they will test your questions based on IFRS 18. No, that is not going to happen for this diet. Okay, so tonight, let's quickly get to the intensive class before, yeah. So I just want to touch on a lot of things that you guys should already be familiar with, and by now you should have read. Okay, I think somebody wants to ask a question before I commence. Okay, go ahead, Frederick, you can.
Good evening, sir.
Frederick, how are you there?
I'm good. Sorry, since I'm in the wrong group, I thought you were supposed to have case study today.
No, no, no. So case study is tomorrow.
Okay, you changed the time.
Yes. So case
I know it's
study is tomorrow
usually
morning.
tomorrow morning.
Yes, you have not been following us on the group. So Frederick, let's continue communications
I
on
know.
the group.
Okay, all right.
Yeah. All right. So if there's any other person that thinks you're having case study, please, it's tomorrow, please. Not tonight. Tomorrow. Okay. So financial reporting, strategic business reporting. So you guys that are doing financial reporting now, you're very lucky. Work hard, keep these materials that you have. You are definitely going to need them. You're definitely going to need them in SBR. You're definitely going to. So the first topic we did This was done for both at across levels was regulatory framework. That was the first topic. And this is like 5% of your syllabus. They mostly ask it. So where we taught you that financial reporting is governed by regulations, and these regulations are developed by regulatory bodies. And I told you that the regulations that governs reporting are called GAAP, which is generally accepted accounting principles. And this gap, they are majorly the rules and principles that guides reporting. And there are three of them: accounting standards, company law, and local stock exchange listing requirements. I can ask you this for 5 marks or for 4 marks. What are the rules and principles that governs reporting? But they can ask you as what are the sources of gap? So when we say accounting standards, know that we are talking about the IFRS or the IAS, International Financial Reporting Standard, or the International Accounting Standard. Those are the accounting standard. And the company law is the CAMA 2020. There's the BOFIA 2020. There's the Financial Reporting Council Act of 2020, and much more. There's even the tax law. These are companies, they are company law. Okay. They are also a source of gap. In fact, a typical one, and I need you to note this for every one of you, because this is quite popular now, is PIEs, public interest entities. And Financial Reporting Council of Nigeria, which is governed by this act, right? They require a lot of reporting from these PIEs. And these PIEs are basically listed entities, even non-listed but are regulated, non-listed entities that are regulated, like bank, for example, is not all banks that are listed, but there are it's banks, financial service industry is highly regulated. So they are also PIEs or a PLC or a government entity, parastatals, or a government contractors, a government contractor that gets contract of over 1 billion, or a private limited entity that earns revenue of over 30 billion per annum. They are all PIs, right? So, in fact, the focus of Financial Reporting Council of Nigeria is majorly on PIs, even though now they are also focusing attention on SMEs, but primarily they direct a lot of attentions on public interest entities. Like there's something now, all PI, in fact, all PI is now required to submit their returns on the Financial Reporting Council of Nigeria website every year. And every year also, all PIs are required to do an ICFR, Internal Control over Financial Reporting, which your auditor is supposed to attest to at the end of the financial year. So a lot of things are going on around this set of companies. So I need you to note them in case you are asked who are PIs. So any of these entities can be PIs. Also, is a concession entity. There are some companies that the government would give his resources to or his infrastructure to manage. Like the Lekki toll gate, it was managed under concession agreement with the government. So the company managing it, or the company that the government has entered into those agreements with, their concession entity. Or the international airport, for example, now, it's usually outsourced to entities to manage, they collect revenue on behalf of government and all of that. Those entities are concession entity. We see them as PIs, and they are supposed to align with the FRC requirements. Okay, so let me not dwell so much on that. What you're majorly taking away from here is just these PIEs, right? So, and you need to know the advantages and disadvantages of rule-based accounting standards and principle-based accounting standards, right? Because when it comes to gap, majorly for us is the accounting standards. In Nigeria, we use the IFRS, and the IFRS is principle based, which goes to show that our reporting framework in Nigeria is a principle based framework. There are advantages to that because principle based framework is a framework that allows for judgment of the users. It's a framework where you that's very flexible. It's a framework where your you can actually tailor your reports to your own activity, right? So even though it's completely flexible, that every entity can adapt that framework to their own circumstance, right? It has great disadvantages. That means people can easily misrepresent or mislead investors because of that flexibility, because of that adaptability. And secondly, is that it might be costly to prepare because it's going to require a knowledgeable person to adopt those principles and be able to present it in an acceptable manner. So, principle based is what we use in Nigeria. And the rule based, we don't use it, but countries like US uses a rule based approach to their own reports. So, and that has advantages too, in the sense that it can prevent all sort of misrepresentation because it is rigid and it provides clarity, right? It makes the directions they give you very clear, that it's very clear what they really want you to do. So it covers a lot of loopholes and prevents fraud as it were, right? But that does not mean it doesn't have disadvantages too. It does, because it becomes very it's not adaptable. It's not something you can easily change like that. And it then becomes very difficult for you to apply in the long term, especially when there are changes, when the economic circumstance in the country is changing, becomes very difficult to apply. So just these are potential questions for your exams that you should not joke with at all. Now, very importantly is the Financial Reporting Council of Nigeria. This is a body that is in charge of IFRS in Nigeria. You need to know at least four of the objectives. And the very first one, like I taught you, is to protect the interest of investors and other stakeholders. They teach companies about financial reporting and corporate governance. And they also ensure accuracy and reliability of reports. And they also ensure good corporate governance practices are adopted by companies and these other ones. So I know that right now, a lot of you will be learning group account. You're learning all these big standards. Don't forget all of this. These are what can make you pass. So come back to this, learn and try to remember this. And also, the Financial Reporting Council of Nigeria is organized into directorates, right, or department as it were. So there's that of accounting standards for private and public. So they have a department or they call them directorates that is in charge of accounting standard for private sector. There's another one accounting standard for public sector. There's other ones for auditing standards, valuation standard, inspection and monitoring, and corporate governance. Like that. Now, when it comes to regulations, right? We have said the regulation for reporting is the gap. And the sources of that is the accounting standards, the company law, and the local stock exchange listing requirements. However, the regulatory body for reporting in Nigeria is the Financial Reporting Council of Nigeria. And these guys right now, I don't know if you have been hearing of them, but they are very solid right now. And to me, they are throwing out a lot of penalties for non-compliant companies. But internationally, the body in charge of IFRS is these guys. IFRS, there's this IFRS foundation structure. And there's this monitoring board that's the boss there that appoints these trustees of IFRS Foundation. And these guys are those that actually develop this IFRS that we adopt. Okay. And I gave their four objectives. So they have asked this before, they can ask you again. You need to know the objective of this trustee of IFRS Foundation to develop a single high quality accounting standards in public interest, to promote the use and rigorous application of these standards, to take care of the needs of SMEs, and to promote convergence and harmonization of international accounting regulations. Go and know it. And under this umbrella, the trustees have some people underneath them. There is the ISB, who has the primary responsibility of working on the IFRS. There is the ISSB, International Sustainability Standard Board, who has the responsibility of developing sustainability disclosure standards. There's the IFRS Advisory Council that provides advice to all of these bodies, and they also help them get data from the markets. And there's the IFRS Interpretation Committee that provides interpretation on standards on IFRS where there are differential opinions in the market. Please revise that. Very important. Another very important thing you need to go and ensure you know is the steps involved in developing IFRS. So I gave you four steps. I said the first step one is agenda consultation. That before they develop IFRS, they would consult, they would make, they will usually go to those in practice and identify if there are any issues. In fact, they do this agenda consultation, they codify all their discovery in a work plan. And this work plan, they look at it every 5 years. So here they will have identified all accounting issues, all accounting problems that needs to be worked on. Then they will then go into research program. That okay, we have a research problem. We have an accounting problem. Let's see if there could be possible solution. Is it a valid problem and is this something we can solve? They will document all that in a discussion paper. This discussion paper would come up like their research reports, where it will have the problem, their methodology, how they intend to solve the problem and all of that. At the end of this research phase, that will determine whether they want to move to step 3 or not. And step 3 is the standard setting program, where they will start the standard setting process itself. And this starts with issuance of an exposure draft. And this is where the accounting problem that they have established exists in step 2. Then they have now worked on it. They have said, okay, this is how we will recognize this item, this is how we measure it, these are the disclosure requirements. All will be detailed in an exposure draft. And they will also explain the basis of their conclusions in there as well. At the end of the day, the exposure draft becomes the IFRS. And of course, they don't just issue IFRS and be looking. They also continue to do post-implementation reviews, which is maintenance program. So you need to go and revise this as well. Know these steps. They can ask you for 5 marks in the exam. So, and you need to revise reasons why regulation of financial reporting is necessary, right? Reasons why regulation of financial reporting is necessary. Why is regulation necessary, right? From the fact that it's going to prevent misrepresentation by users, by preparers of financial statements. It would reduce them misleading the users of financial statements. And also, it's going to ensure that financial reports are presented in a standardized or coherent way. With regulation, it ensures that because there will be regulation around how you treat items. And it also ensures that financial reports are reliable and also relevant. And ultimately, it will even improve the confidence of investors in the report that is presented by companies. So that's the topic one. It's something you want to take a look at. In case it comes out in the exam, is a potential 5 to 7 I've seen a question on 10 marks severally in this area of your syllabus at both levels. At both levels. Now, another very important one is ethics in reporting. Ethics in reporting. So you need to understand that reporting is governed by ethics, and we have some fundamental principles that we need to comply with: integrity, objectivity, and all this. And there are these threats that would want to impair those principles. And these are the safeguards that we need to guide against those threats. So I can give you cases where they would give you ethical issues, where they would tell you somebody is trying to do the wrong thing, or somebody is coercing you to do the wrong thing. So you need to sequence your answer in this order. You need to sequence your answer in this order. If you're checking past questions, you should have seen some of those questions. You need to be able to advise the entity first around the fundamental principles, around the fundamental principle that what they want to do is wrong because it is against either integrity, objectivity, or professional competence, professional behavior. It's just like a guy, there's this scenario that I saw in, I think, either in skills or SBR, I can't remember, but it was around a company. They sold their company to another company. And when they now employed a new finance manager, that one now overheard some people in the canteen. They were saying that, that their CFO, the company, the guy is not a nice person and all of that. And he suppressed the value of the company because the the director in the company that want to buy them, the director is his wife, and he undervalued their company when he was going to sell their company to those people because his wife owns that other company. He overheard that. And that was the scenario given to you. I mean, just play around these three major headings that, okay, that first, um, you have had an information like that, and you need to exercise on your own professional competence and due care. You cannot just hear side opinion and you want to take that objectively and use that against your boss, right? Then for you now, um, based on the information you have had, it's probably a situation of a self-interest threat. It's probably a situation of a self-interest threat for this company, for this staff, or for that CFO. He must have acted because of either familiarity, is familiar with the person, and which was what must have influenced, even if he has done that. Okay. But however, before you act, the safeguard you should enter into is to communicate with that your line manager, that CFO first. That's the first thing you should do before you conclude. You have identified the fact that you need to act competently. You have identified the fact that even if it is true, it therefore means the CFO is either exposed to familiarity threats or a self-interest threats, right? So what you need to do, the action you need to take is communicate with him and discuss about the ethical issue you have had. Then, based on his response, we determine the subsequent action, right? But when you communicate and is able to explain that the figures were done independently, then that means you might have to then believe him. But if his communications are not clear and you can see signs of dishonesty, then that means you need to escalate the ethical issue to audit committee of the board, who are responsible for any financial reporting matter for any entity. Then hopefully the matter should end here. If it doesn't, you escalate externally to either professional bodies or regulatory bodies, as the case may be. And if you see that this company is not worth working with, then you resign if you can, because you should not be associated with an unethical company. So these in your exams are very important. And these are the areas I see students ignore. And these are 5 marks, 7 marks, 10 marks. I've seen 10 marks severally. Go and read these things very well. Don't sit down on group account, published, or financial instruments. That might not come out. No, publish will come out. But financial instrument might not come out. They could ask it, they could not ask it. They might not ask it. But all these simple ones, please don't throw them away. Which is why I've suppressed all of this for you, just so that you can glance through and always remember them. Now, another very important one is conceptual framework. This also, they can ask you around advantages and disadvantages, but know that conceptual framework is the principle that underpins the development of IFRS. In fact, they use conceptual framework to develop IFRS. Okay, so I gave you some advantages here. And you also have disadvantages of this conceptual framework. So majorly, you can see that the advantages is it makes development of IFRS coherent and standardized, right? And users can see that regulations are from a single source, and it can help to treat unusual transactions, and it ensures similar transactions are treated in a similar way. I gave you some of the purpose of the conceptual framework, and in identifying the purpose of this conceptual framework, I actually played around who uses this conceptual framework. Then I use that to establish the purpose, right? Like the ISB, they use the conceptual framework to develop standards. They use it to develop standards like the ISB. They also use it to harmonize international regulations. And also, you will see that users of financial statements, they use it to understand the financial statements. And also the national accounting standard setters, they can use it to develop their own local standards. Also, is the IFRS Interpretation Committee. They use it to develop interpretations on IFRS. And there is the auditors that use it to form opinion. So, try to learn that. Then I also looked at the content of conceptual framework. I gave you 8 chapters, okay? Where they often ask questions is this chapter 2, qualitative characteristics. So you can look through this chapter 1. I explain some key things, but you can spend more time here because that is the area that has high likelihood of questions. 10 marks. You don't want to joke with that. Where they ask you the qualitative, explain the qualitative characteristics. I give you fundamental and the enhancing characteristics. And the fundamental, there is relevance and faithful representation. So they can ask you to explain relevance for 2 marks, faithful representation for another 2 marks. And I told you that relevance means that the financial information must be capable of making a difference in the decision made by you. And I said it's capable of making a difference if it has predictive value and also confirmatory value. So, an information would help make a difference if that financial report helps users to make predictions. And the way reports are prepared based on the standards, some of the standards, like IFRS 5 now, with discontinuing operations, right? Because IFRS 5 says that if an entity wants to discontinue business, or when you plan to discontinue, you must present that discontinuing operation separately. I mean, anybody that sees that would then be informed that, this company wants to discontinue this segment later in the future. And you can use that to predict, to plan like that and confirmatory value. But you don't need to start giving all these examples if they just ask you for relevance, anyways. So under relevance, there's something we call materiality. Materiality affects relevance directly. And for faithful representation, you need to be able to tell the examiner that for reports to be in fact, your information must be faithfully represented, and this can only happen if the information is complete, neutral, and free from error. So these three makes up faithful representation, and I gave you some examples here. Another key thing under faithful representation is measurement uncertainty. And this is speaking to the fact that we use a lot of estimates when we are determining our figures in the report. But when we are making estimates, make sure that it has a basis. Make sure that you explain those bases in order to reduce the uncertainty. Because when measurement uncertainty is too high, it's going to affect faithful representation. So you should ensure that our measurement uncertainty stays at a reasonable limit. You need to have a basis. I mean, example is you want to depreciate, you need a useful life of the asset. You need to have a basis for determining the useful life. Either you use the documentation that must have given you by the manufacturer of that car, that this car can last for 5 years or based on the mileage, or you can use a similar car that you have bought before, similar to this one that you just acquired. And you can use how many years you used it. You can also use that as a basis for determining. I mean, don't just estimate. Just because they say you can estimate, you then go and make some unreasonable estimates like that. And there's something we call substance over form, right? It's really economic substance over legal form. And there is no way you can present your information faithfully if your transaction are not presented in accordance with economic substance. So we consider economic substance and not legal form. And that was why when I taught you IFRS 16, you saw that the lessee, that is not the owner of an asset, can confidently recognize an asset in his books and call it right of use asset, even though it is not his own. And that's because, yes, this asset is not his own legally, but when you look at the substance here means who is collecting money, who is making money from this asset. It's you, the lessee. If it's you for the lessee, then you need to present that in your books as an asset. Substance really means that when a transaction meets the definition of any of the elements of financial statement, you need to treat them in that order. Or you said you sold an item to a third party or to a customer. You said you sold. Ordinarily, you should recognize revenue. But when you sold, you are now telling the same customer that I'm going to buy this item back from you in the next 2 months. I mean, that is, you cannot say you have sold anymore because you're going to buy the same item. The substance there is close to you, is as good as you did not sell. You say you sold and you're saying you're buying the same item back. IFRS 15 will say no, that's a sales and purchase agreement, and you cannot recognize such as sales because the substance is showing that you did not, and much more like that. So there are other enhancing characteristics that you need to also take care of. There's chapter 3. There's really nothing, no big deal around that. Talking about reporting entity, reporting period. There's chapter 4. I mean, by now, every one of you should know these definitions. I mean, you should know definition of an asset. You should know liability, equity, and all that. You need to come back to this. By now, you should have been hearing recognition, right? This basis, everything you learned in all of those standards, this is where the tone was set, right? That you see these elements, which is everything we taught you in reporting, before you can recognize them, okay? Before you can recognize any element, any item, any transaction, they must meet the definition of the element above. Any transaction that meets any of this definition, any transaction that meets the definition of an asset, recognize it as an asset. So the criteria for recognition is that the transaction must meet the definition of any of those elements. And secondly, is that you must ensure that the item you want to recognize is relevant and it will faithfully represent the transaction. And of course, when you lose control of an asset or you settle the obligation, then you should derecognize the item. And we set some pace for some measurement basis. There's presentation of, and there's concept of capital and capital maintenance. I need you to also remember this concept of capital and capital maintenance. They can ask you at all levels because in reporting, there are two concepts of capital. There is the financial concept of capital. There is the physical concept of capital. The financial concept of capital is the one we use right now, where the way we present capital, we present it as the money used to start a business. We present it as the nominal amount of capital, right? But there is another concept, which is physical, that looks at productive capability or capacity, that looks at what can you produce, that look at what's your inventory capability. That's a physical. So when you want to look at your capital from a physical perspective, it looks at what you can produce for the year, not what you have as capital. So from the concept of capital, then we can deduce what capital maintenance means. You see, you have maintained your capital generally when you make profit. So if you are using a financial concept of capital, you have made profit if your closing capital is higher than your opening capital. You have clearly made profit and you have maintained your capital. Straightforward. But for physical perspective, you have only maintain your capital if your productive capacity at the end is higher than your productive capacity at the beginning. Like when I was explaining this, I said that if this guy that has 10,000 capital at the end, at the beginning, can produce 1,000 units, but this guy, at the end, he has 12,000 capital, but that capital can only produce 900 units. He hasn't maintained his capital. Okay, of course, you ask that why would they have 10,000 naira? And that is equivalent to 1,000 units. And at the end, he's having 12,000, and that is 900. That's inflation. Prices are now high. To produce one unit of that same item has gone up, has skyrocketed. So even though we don't use this approach, but know that it exists, right? And it usually considers inflation when you're determining your cost of sales. Before you know whether you have made profit or not, you would add inflation to it. And the typical one is this. I gave you this scenario. Now look at this scenario with you before you, because don't be surprised when you find it in your exam. It says that Wasu's activities includes the production of maturing products, which take a long time before they are ready to retail. Details of one of such products are that on 1st April 2009, it had cost 5 million and a fair value of 7 million. The product will not be ready for retail until 31st March 2012. So this first paragraph is telling us that I usually produce a product that takes a long time before I can actually sell them. So I have one of that product in 2009. It cost me 5 million to buy, and it has a fair value of 7 million. And this product, I cannot sell it until 2012. But in 2019, I entered into an agreement to sell the product to Easy Finance for 6 million. The agreement gave Wasiu the right to repurchase the product at any time up to 31st March 2012 at a fixed price of 7.9 million, at which date Wasiu expected the product to retail for 10 million. The compound interest Wasiu would have to pay on 3-year loan of 6 million would be year 1, 600, year 2, 660, year 3, 726. The interest rate is equivalent to the return required by equity finance. So this second paragraph is saying that I entered into an agreement to sell the product to Easy Finance in 2009. That means this guy, Easy Finance, will have paid me 6 million. But I can actually buy the product back before 2012 at a fixed price. I don't know why they entered into such, but they have entered that, okay, the guy gave me 6 million and I can buy it back from him before the product is ready for retail at 7.9. And at that time, I can easily sell that product again for 10 million. Now, that 6 million that this guy gave me, if I had to go out to borrow, I'll have paid interest of this for each of those intervening period. Now, this question is asking me that I should prepare accounts that, assuming the above figures prove to be accurate, prepare extracts from the income statement for Wasiu for 3 years, reflecting the legal form, the substance. If I want to prepare these in accordance with the legal form, you see, at the end of the first year, I entered into an agreement with this guy in 2009. At March 2010, at the end of the first year, I will say I've sold because legal sees agreement to sell as sales. So they would recognize this as 6 million. Of course, the cost of sales is 5 million. That's how much I bought the goods. Nothing happened in 2011. But in 2012, right, I can eventually sell this item again. If I bought it back from me, I will sell it for 10 million. That's if I had bought it back for 7.9, right? So, and why I'm recognizing this is because I've entered into an agreement with him again to buy it back. So I can then sell it for 10 million and buy it back for this. So my total revenue is 16, my total cost is this, my profit is this. But if I want to prepare this in accordance with the substance, in 2010, that I entered into an agreement to sell, I'm not going to recognize any revenue because I cannot even sell this item until after 5 years. That is when it's ready to retail. And IFRS 15 says that your revenue must depict the consideration expected from the transfer of promised goods or services. I haven't transferred any promised goods or services. So there is no universe where I can recognize a sale. So we will say, no, don't recognize the sale. Substance will only recognize a sale when the item is ready to be sold, which is 2012. And I can sell it for 10 million. And substance will recognize the historical costs, which is my cost of production, right? Which is this 5 million as of when I produce this item. How much it cost me to buy it. That would be my. And now, since in real life, I've already collected money from that customer, even though I did not give him any goods, right? Substance will say that money you collected is as good as you collected a loan, which you have to pay interest on. And that's why we need to recognize interest for each of those years. Can take your time to look at this. If you don't get it, just Just let me know. So those are the major theoretical things that we discussed before we started the other parts of the syllabus, the standards. Now, let me quickly go through the standards with you. Do anybody have any comments so far? Now, by now, by now, I expect every one of you to have mastered IS 16 in whatever way possible. You should know about the definition of PPE, recognition criteria for PPE, subsequent costs, measurements, the recognition, disclosures, and you must have solved some past questions. You should know that PPE is any tangible item that is held for use in the production or supply of goods or services, rental to others, and for administrative purposes, and it is expected to be held for more than 1 year. You should all be familiar with this standard, with this definition of PPE, a tangible item held for use, production or supply, rental to others, and for administrative purposes. And very importantly, it is expected to be held for more than one accounting period. And before you can recognize PP in your books, you must meet these two criteria. Number one is it must be probable that future economic benefit associated with the item will flow to the entity. And two, it must have a cost that can be measured reliably. You have to know this. They can ask this for 3 marks in the exam. More. So when you have identified that this item is capable of generating future economic benefits, and this item have a cost, then go ahead and recognize it by debiting PPE and crediting the mode of payments. Either bank, if you paid in money, or payables, if you have not paid, or other income, if they gave you, if you did not buy it, but somebody gave you for free, or if it's a government grant, credit grant income, as it were. So, how do you measure PPE? So, initially, it's measured. There is initial measurement and there is subsequent measurement. The initial measurement is the measurement at the date of the transaction. The subsequent measurement is the measurement at the end. So, PPE is initially measured at cost. You must know this component of costs. I gave you like 4 components. You must know all the 4 components. So at least you should be able to tell the examiner if they ask you what are the components of costs, that this includes the purchase price plus import duties plus non-refundable purchase taxes, less trade discounts and rebates. Should be able to tell them that it includes directly attributable costs of bringing the assets to its location and condition for it to be capable of operating in the manner intended by management. And number 3 is the initial estimates of the cost of removal, dismantling, and restoring the site on which the asset is located, which we call decommissioning costs. And there is also borrowing costs that are directly attributable to the acquisition and construction of the assets. So I can have seen them ask you severally that you should give examples of directly attributable costs. You don't want to joke with this. Leave, yes, the calculations, yes, but don't jump over this. So you need to at least know this four or five. Initial delivery and handling costs, installation and assembly, professional fees, site preparation, employee benefits that are directly attributable to the acquisition of the assets. There's pre-production testing costs. And I've seen them for 4 marks. Ask you that you should list costs that are not directly attributable. And I've summarized it for you here. So, which is why you can try your best. For those of you that have attended our class from A to Z, if you can glance through these materials, this collated one, just know everything inside. You're fine. Everything they will ask you, over 90% of it, you're going to find it. It's very similar to what you have looked at before. So the first is the cost of opening a new facility or startup cost or similar pre-production costs. That is not directly attributable. The cost of introducing a product to the market, like advert and relocation cost, no, staff training, no, general and admin, no, initial operating losses, no. These are the costs that are not directly attributable. Be familiar with it, please. Now, after your initial measurement, there's something we call subsequent cost, which of course is, okay, you have bought this asset, yeah? You have recognized its initial measurements. After, when you start using the asset, you need to repair, you need to replace parts, you need to do some improvements, you need to do some major inspections. These are subsequent costs. And these subsequent costs, are you supposed to capitalize them or expense? So you usually add them to the cost of the asset if they meet the recognition criteria, which is the same recognition criteria up there. That if it has future economic benefits, if it has a cost that can be measured reliably, capitalize. Otherwise, expense. And for subsequent costs, you only capitalize if the examiner tells you that the cost is capable of improving the productive capacity of the assets or the useful life of the asset. They will tell you when it comes to subsequent costs, they will tell you, I can guarantee you that. So these are what you look at. Is it improving the productive capacity? Is it going to improve the useful life? If it's yes, then you should capitalize. Now, subsequent measurements, which is the measurement at the end of the year. So I've seen ICAN ask you that you should explain um, the subsequent measurements in line with IFRS, in line with IAS 16. Cost model and evaluation model, very straightforward. Cost model is just cost minus accumulated depreciation minus accumulated impairment losses. Revaluation model is fair value or revalued amount minus subsequent accumulated depreciation minus accumulated impairment losses. And that is it. You get your 3 marks and move forward to another question. So I really explained the two to you. That if you're using the cost model, it's of course used to determine carrying amount of an asset. And this is how you do it. And I said, this cost model is something you would show that you find in the notes to the account under your fixed asset schedule. They will present the cost, accumulated depreciation, and all of that in a schedule like that. And I emphasize that that schedule, the figures, these costs, you find it from the asset account. Accumulated depreciation, you find in the accumulated depreciation account. Accumulated impairment loss, you find it in accumulated impairment loss account. So that is just telling you that, because some people, I know that none of you think that anymore. They will think asset account, that when you have an asset account, that what you find there is the book value. That's where you find the book value or the carrying amount of an asset. See, I emphasized it here that asset account is always at cost. When you have an asset account, what you will always find there is the cost of the asset. What can increase it is if you bought additional assets or if you incurred subsequent costs that you capitalized. You will never find depreciation in an asset account. No. Depreciation goes to its own separate accounts, depreciation accounts, and is accumulated in an accumulated depreciation account. So when we say cost model, it's just a way of determining carrying amount and is determined using this formula. The same thing applies to evaluation model. If an entity is using evaluation model, what you find in their asset account is just the fair value of that asset or the revalued amount of that asset. That is all you find. So you would never find carrying amount of an asset in an asset account. No. So what evaluation model does for us is, okay, in your note to the account, this is how you determine what you would put in your statement of financial position under your fixed asset schedule. But since you are using evaluation model, it will be fair value minus subsequent accumulated depreciation minus accumulated impairment losses. And putting subsequent under evaluation model is very important. All right. So unlike cost model that we say cost minus accumulated depreciation minus accumulated impairment losses, which is fine. But evaluation model is actually fair value or revalued amount minus subsequent accumulated depreciation. And the reason is that whenever we revalue an asset, all the previous depreciation are usually written off. They are usually written off. You start depreciation over again when you revalue an asset like that. Then, having explained that, we also went into how depreciation is determined, and the highlight here around depreciation is to understand the fact that at your level now, I'm sure none of you should have it in mind that depreciation is the wear and tear of an asset. By now, nobody should have that kind of impression that depreciation is wear and tear. This shows you clearly, according to IS 16, that depreciation is the systematic allocation of the costs or depreciable amount of an asset over its estimated useful life. Some people even think depreciation is the money they set aside to replace an asset. No. So depreciation is just a systematic allocation of the costs or depreciable amount of an asset over its estimated useful life. In the sense that when you buy an asset for 500,000, that asset will be used for more than 1 year or like 5 years. So we don't expect you to put the whole of the 500,000 as costs or as expense for that year. Why? Because the asset will be beneficial for you for 5 years. Therefore, we expect you to also put that 500,000 as costs or as expense over 5 years. That's what depreciation does for us. When you see depreciation in your P&L, it's just the portion of that asset that we're expensing for that year. That okay, oh, this is just spreading, systematic allocation of that. That is all it does. We are just spreading the cost of an asset over its useful life. So there are different ways of doing that. They could use straight line, they could use reducing balance and all that. So I explain some details on how to determine useful life. I've seen them ask this for 4 marks. That's how do you determine useful life, or what determines the useful life of an asset? So you need to note when you're revising, don't just gloss over this. We looked at straight line method, the reducing balance method, and you need to know that straight line method is calculated by cost minus residual value over the useful life of an asset, or they could give you a depreciation rate. When you're using straight line method, the depreciation rate will be calculated on the cost of the asset. And that's where reducing balance differs from straight line, because for reducing balance, they will always give you depreciation rates, but the depreciation rate is always calculated on the carrying amount. That's how you calculate depreciation under reducing balance. Depreciation will be calculated on the carrying amount, except for the first year of depreciation, where you have to calculate it on the cost. I know that carrying amount is cost minus accumulated depreciation. That's your carrying amount. And that's how you do depreciation. And when you calculate your depreciation, you put it in P&L as an expense. The other leg, you take it to accumulated depreciation. Okay, let me even know if I'm speaking to people in this class. I've been talking alone without response for over 1 hour. Let me ask you a question. Now, okay, good. This accumulated depreciation, right? Where do you take it to? Where does it go to in your financial statement?
That's good.
Say it again.
Net asset schedule, sir.
Assets,
Say it again. I didn't hear you.
Asset schedule.
asset schedule.
Non-current asset schedule.
Fantastic. Fantastic. Thank you very much. It goes to the asset schedule. Fantastic. That's where it goes to straight on. So that would then help you to calculate your carrying amount, which you would take to statement of financial position. So I gave some example that you want to calculate depreciation, cost over useful life, then 15,000 P&L. In your statement of financial position, in the notes you see in your schedule, you have cost minus depreciation gives carrying amount like that. Then is this carrying amount that goes to your statement of financial position, and you do that for the second year as well, like that. And I'll give you another example that if they give you costs, accumulated residual value depreciation rate, and they ask you to calculate depreciation using straight line and reducing balance. So if you are using straight line method, if you use this formula, it will not fly because they didn't give us the useful life, but they gave us a rate. You just apply the rates on cost minus residual value. Costs minus residual value. That will give you depreciable amount. Apply your depreciation rate on that. That will give you your depreciation. And this depreciation, it goes to P&L. The other leg goes to accumulated depreciation, which you would, in your notes from your schedule, you do your costs, which is 500,000, minus accumulated depreciation, which is 175. Then carrying amount, you get what you need to get. And why is this 175? That's because This is not the first year of depreciation. There was an accumulated depreciation brought forward of 80 plus the depreciation for the year. And that's why we are having 175. Then this carrying amount is what you take to your statement of financial position. But with the same scenario, if you want to determine depreciation under reducing balance, that one, you are going to do depreciation rate times carrying amount. The carrying amount is cost minus accumulated depreciation brought forward, which is this question. So you then apply the depreciation rate on that, and that gives you the depreciation for reducing balance. You need to be able to, this question, the scenario I gave you, really simplify the difference for you. Then it's possible to also calculate depreciation where the useful life is given in units. When they give you useful life in units, the examiner will definitely give you the unit produced for each year, because that will be the basis of determining your depreciation for each year. In this case now, they gave us cost, residual value, useful life, and they gave us the production per year. To calculate your depreciation, I will need to get depreciable amount, which is cost minus residual value. When I get my residual value, I can then do how many units did I produce in year one? 2,000. All upon the total units producible, which is 5,000, multiplied by my depreciable amount. That gives me depreciation in year one. Depreciation in year two is the units produced in year two over the total times depreciable amount. And I do the same thing for year three. Then I'm able to calculate my depreciation for each year when you are given in units. I've seen a past correction where depreciation was given in units, and that threw a lot of students off balance. I'll show you very soon. Now, when you are doing evaluation, the key thing around evaluation is the fact that whenever you revalue an asset, it will result in revaluation surplus or revaluation deficits. Now, the examiner, of course, you find this in your exams. You definitely find it. It's there every day. So the examiner really cares a lot about understanding how evaluation is determined, how evaluation surplus is determined or deficit. So notice that revaluation surplus is determined as revalued amount minus carrying amount, not revalued amount minus costs. It is revalued amount minus carrying amount. So you need to get carrying, and you know that carrying amount is cost minus accumulated depreciation. So it's important you establish that clearly to get evaluation surplus. So whatever surplus you get, you use it to impact your assets, and also the other leg, if there's a surplus, it goes to OCI. If there's a deficit, it goes to POL. However, when you have a surplus and there is a previous deficit on the same assets, in this case, the evaluation surplus will go to P&L to the extent of that previous deficit. Yes, when you have a evaluation surplus, it goes to OCI, other comprehensive income. But we are saying here this and that if there is a previous evaluation deficit on the same asset, in that case, you will need to take that surplus you have made to P&L, though to the extent of that deficit. And this is what we are saying, that if it's in 2002, you made a revaluation deficit of 100,000. In 2003, you now made a surplus of 120. So in 2003, see this surplus, it goes to P&L first. But since we made a surplus of 120, and the reason it's going to P&L is because we made a previous deficit of 100. So it will go and net off that previous deficit. And that is why only 100 has gone to P&L to net off that revaluation deficit. Then we still have an excess surplus of 20. We can then fly that to OCI, where it belongs. On the flip side is revaluation deficits, which is where, in this case, we made a loss. The carrying amount is higher. And the same principle applies. Deficit should go to P&L. But if there is a previous surplus on the same assets, then that deficit will go to OCI. Like in 2002, we had a surplus of 230. In 2003, we now have a deficit of 300. You see, in 2003, this deficit of 300 we have, it will not go to P&L. It will go and net off against the previous surplus. It will net it off. And that is why we took only 230 to OCI to net off the previous surplus. We cannot take more than 230 to surplus because it's only netting off the previous surplus. Now, the excess of 70 can then go to P&L. The excess of 70 can then go to P&L. Again, when you have revaluation surplus should go to OCI. When you have revaluation surplus, it should go to OCI. But if there is a previous deficit on the same assets, there is a previous revaluation deficit on the same assets, that's the only case where you find revaluation surplus going to P&L. Just like in 2002, you had a deficit of 100. In 2003, you now had a surplus of 120. In your account, you cannot take this 120 to OCI straight on, no, because there was a previous deficit. So you need to go and net off that first in P&L. That's why we took 100 to P&L out of this 120 to net off this previous deficit. The remaining 20 went to OCI. The remaining 20 went to OCI. If it's deficit, you see, deficit should go to P&L, is a loss. The only situation where it will not go to P&L is if there is a previous surplus on the same asset. It needs to go and net that off in OCI. That's this scenario. If you have in 2002, you had a surplus of 230, a deficit of 300. When you're preparing your account for 2003, this 300, you can't take it to P&L. It needs to go and net off this previous surplus to the extent of that surplus. That's why we took 230 to OCI. And the balance can then go to POL. The balance can then go to POL. Okay. Yeah. You can ask your question.
Okay. So I want to understand what you're explaining. For instance, now, no, it's not for instance, how to treat revaluation surplus when there is an already revaluation deficit in the prior year. So you first off nil off the amount that was in deficit, then put the outstanding amount in OCI. So my question is, what if there is no outstanding amount? Does it now mean that when there is no outstanding amount to put in OCI, what do we now do? Again, um, what if there were no deficits in the prior year? Where do I, in real term, where do I treat revaluation surplus?
So if there is no excess, like for example now, if the previous year deficit was, let's say, 150, right? So this 120 will just net off against that 150. So that means we'll have a balance of 30 that we are carrying forward as deficits in the books, right? A balance of that we are carrying forward as deficits in the books, and that's how that works. That means there's no balance, not it. So if there is no previous deficit, then fine. Evaluation surplus naturally goes to OCI. Take it to OCI, right? And from OCI, OCI means statement of other comprehensive income. And from there, it goes to equity under evaluation reserve, like that. I
All
hope that
right.
answers your question.
Yeah. Yes, it does.
Okay, good. So I gave some scenarios then that can really help you. I'll just go over this again because evaluation is important. So I gave some scenarios then that, okay, if you have costs of 150, accumulated depreciation of 30, evaluation amount of this. I did some analysis for you that your evaluation surplus here, which is the most important thing, is not 170 minus 150. That's wrong. It's 170 minus the carrying amount. And the carrying amount is 150 minus 30, which is 120. So evaluation surplus is 50, right? So you might care less about this. You might care less about this, really. At this level, I don't want you to start arguing your head around this. What is important is that this evaluation surplus ends up in OCI. Take it to OCI, right? Scenario 2, you have a cost of this, accumulated depreciation of this. There was a previous evaluation of this. Revalued amount is this, right? So for this, our revaluation surplus or deficit is the revalued amount minus the carrying amount, which is 230 minus 45, which gives 185. That means we have 5,000. Okay? If I hide this, if I may ask you, is there anyone, how do you treat this 5,000? Where does it go to?
It's there.
Again?
The 5,000 will
P&L.
go to
P&L.
P&L, sir. It goes to P&L.
Why?
Because it is a revaluation deficit, sir. We have to take it to P&L. If it's a revaluation surplus,
There
it
was
will
a
go.
previous surplus that was treated to OCI. So this deficit will go to OCI. You have to take it out.
Correct. 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 So you need to be very careful to check your trial balance and the information given to you. If there was a previous surplus, there was a previous evaluation surplus. So this will go to OCI. It's to go and net off that surplus. You will not take it to P&L. Okay. I think those were two scenarios I gave you. And you see, I also taught you about disposal. When you sell PPE, you compute gain or loss on disposal. And gain or loss on disposal is computed as sales minus carrying amount. and you take this gain or loss to P&L. Careless about this. Doesn't really. And this is the disclosure requirement for PPE. You need to know this. Measurement basis, useful life depreciation rate, and all this. And this is a fixed asset schedule that I gave you that time that we had always used. Even when we were doing cash flows, we use this schedule like that. Yeah. I think I also made mention of what is it? I also made mention of something we call excess depreciation. So before then, I told you that when an item of PP is disposed, I said the revaluation surplus on the disposed item asset becomes realized. You know that revaluation surplus is like unrealized gain. That's why it goes to OCI. So when you eventually sell that asset, that evaluation surplus becomes realized. Then whatever evaluation surplus you are putting in evaluation reserve in equity, you can then take it to OCI to retain earnings. So you see us debiting the reserve and crediting retained earnings. So it's as good as saying you're transferring it to retained earnings because now you have earned it. Since you have sold the asset, you will have then collected the money. However, if there is any, alternatively, let me know, however, alternatively, IS 16 says, okay, why wait till when you sell an asset before you realize it, before you realize the revaluation surplus? It says that there's something called excess depreciation, okay? And this name is determined by the fact that when you revalue an asset, the depreciation has a way of increasing. So there is usually an incremental depreciation when you compare the old and the new. So that incremental depreciation, they say that, okay, we can use that as the amount you are earning every year from that asset as you continue to use the asset. So they are saying that instead of waiting till when you sell these assets before you say you have realized it, why not spread that gain over the remaining useful life of the asset? So we call that excess depreciation, and it's calculated as revaluation surplus over the remaining useful life of the asset. Whatever you get, you would usually use that to transfer. You transfer it from that surplus to retain earnings every year. But I told you something then when I taught you this, that this is not a compulsory requirement. This is not a compulsory requirement. It's optional. You don't do this unless the examiner tells you to. Unless they tell you in the question that is the company's policy, to earn revaluation surplus through retained earnings or to transfer revaluation surplus to retained earnings. Unless they tell you that. If they don't tell you, you don't assume. You don't assume. So it's not pronounced in most questions, but if you see it, right? If they tell you that this company has excess depreciation, know that it's computed as whatever evaluation surplus you have computed divided by the remaining useful life. And all you do with it is just to remove that amount from the evaluation surplus and take it to retained earnings. That's all you do with it. Now, there are a lot of questions that you can look at on PPE. These are areas that you should practice. So I use this to 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 teach you how to calculate the cost of an asset. And you see that From that component of cost, the major items here are the purchase of land, cost of dismantling, which is site preparation, material, employee benefit that are directly attributable, production overhead, the one that is not direct, the one that administrative overhead was removed, architect fees, borrowing costs, dismantling costs. These are what goes into initial cost of an asset. I'm more attracted to this. Why is this 8/9? Which note is that? For employee benefit, that's not one. You see, they said the factory was constructed in 8 months to 31st March. It was brought into use in June. The employee benefit costs are for 9 months. So that goes to show that the staffs that participated in the construction of this new factory, the salary we pay to them, we see it as part of the cost of that factory. So since they said that this salary is a 9-month salary, but we constructed the factory for 8 months. That was why we only capitalized just 8 months portion. This production overhead, let me see. They said the production overhead were incurred in the 8 months. This include an abnormal cost. Abnormal cost cannot be capitalized. And yes, we usually capitalize production overhead. So we don't, if it's a general or administrative overheads, those are not capitalized. So that's why we ignore that. And these interests, note 3, this guy took a loan to fund construction. You see, anytime you take a loan to fund the construction of an asset, the interest to pay on that loan is capitalized, and which is why the borrowing costs, we capitalized it. Though, since the interest is per annum, is 10% per annum, so we need to prorate it. That was why we did only 8/12. Since the construction took 8 months. You see, cost like allocated, you expense this. Cost like relocation of staff, expense it. Opening a new facility, those are not directly attributable because they are usually expensed like that. And I saw some other questions for you on how to calculate depreciation. All these are very straightforward. And there's this other one. You don't be surprised if you find this particular question in your exam. So let's just quickly use this as a revision. So if I may ask you, what this question was about is, okay, that you should calculate the cost of this asset. So, and these were the costs that they incurred in total. Now, this supplier's invoice price, of course, that's the purchase price of the asset. Who can tell me, what do you do with this trade discount?
Sir, you less it though.
You less it from the cost, that's correct. What do we do with this early settlement discount?
It's not applicable.
It's not applicable, yes, sir.
That's correct. That's a cash discount. Okay, and the reason it's not applicable is that this one is not given immediately. In fact, you don't even know whether you get it or not. It's a conditional discount. It's like, okay, if you pay early, I would give you discount. No, no, now we want to get the cost of the assets today. The initial cost, that's what we want to get. So now they are saying that, okay, if I pay early, they will give me. No, that cannot constitute part of my cost. So you see, if you eventually get these discounts, and now that we cannot reduce it from our costs, how are we going to treat it? If you eventually get this 5% discount, how do you then treat it? Anybody?
I think you
Becomes an income as discounts received.
Thank you very much. Absolutely correct. It becomes an income as a discount received. Correct. Since you cannot reduce it from cost, then you treat it as an income at that date. Okay. So this freight and shipment costs, is it capitalized or expensed?
Capitalized.
Capitalized.
How about this stevedore expense?
Capitalized.
Capitalized.
How about, correct. How about these initial operating losses?
We ignore.
Expensed, yeah.
Yes. It's
Expense. How about this handling cost?
Capitalized.
capitalized.
Correct. How about this electrical and installation cost?
Capitalized.
Correct. How about this interest on loan to the point of usage?
Capitalized.
Expensed.
Capitalized.
It's
Expensed.
expense.
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 Expensed. Oh, okay. So why is it expensed?
Because we are buying ready-made product. We are not
Thank you very
constructing it from
much.
the
Yes,
beginning.
it has
Correct.
been.
That's absolutely correct. Because you only capitalize interest if you are constructing the asset yourself, just like the previous question. If you are not constructing the asset yourself, any interest you pay on the money you borrow to buy the asset, you expense it. So these two interests will be expensed. What are these pre-operational expenses?
Expense.
Expense.
That's correct. What about start training?
Expense.
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 How about professional and consultancy fee?
Capitalized.
Capitalized.
Capitalize.
Correct, correct. And that's because they say it's unadvised to buy the machine,
Yes.
right? So how about these 4-year maintenance
Expense.
contracts?
Yes.
Expense.
Over how many years?
4.
Yes.
Over for
Correct. How about this pre-production testing cost?
Capitalized.
Capitalize.
Correct. Capitalized testing cost is a directly attributable cost. Now, this is the question I was telling you that they give us the useful life in units. You see that they give us the useful life in units. So from here, we can see that the output for each year, 1,000, 800. If you add it together, what does this give us? This 2,000 plus 2, 4. That's 4,004.
4,400.
4,400. Okay. So I was told that on 1st September 2016, the company decided to upgrade the machine by adding a new component of 300,000. As a result of this new upgrade, there was an increase in remaining useful life of the remaining useful life of the output to 8 million. What was the original useful life of these assets, sir?
5 million.
Where is it?
Up there.
Okay. Okay, 5 million units. Okay, correct. Okay. So it increased to 8 million. All right. So, and also the residual value of the machine was revised to 114. So first is this. When did you buy these assets? September 1st, 2015. From this exercise we have done, we will have known what the initial cost of the asset is as at September 1st, 2015. Now, first is this. We can determine depreciation in year one first, but I'll come to that. Now, this is the end of the beginning of year two, this September 1st, 2016, because year one is September 1st, 2015. That should end in 30th August 2016. So this is year two. Now, this 300, which is cost of upgrade of the machine, are we capitalizing it or expensing it?
Capitalize.
Why are we capitalizing it?
Because
It's a
the
major.
money, it brought additional value or additional output to the equipment. So we are going
That's
to capitalize it. It adds
absolutely
to the
correct.
life value. It adds to the expected life value
Useful
of
life.
the asset.
Absolutely correct. Okay, good. So we'll come to that. So first here, the examiner say, okay, what's meant by depreciable amount? Which is depreciable amount is cost minus residual value. You all know that. They said, what are the three characteristics of a depreciable assets? One, they have a limited useful life. Two, they are held for more than 1 year. Three, they are held for production, supply of goods or services, rental for orders, or for administrative purposes. Four, they are capable of generating future economic benefits, right? Those are characteristics of a depreciable asset. They say describe the two models of accounting for cost of PPA. Who can get these 3 marks? Anyone?
Who can what?
Who
The
can
two
get these three
models of
marks here?
accounting for cost of is the cost model and the revaluation model itself. The cost
Okay.
model is the cost minus the accumulated depreciation minus the payment losses.
Okay.
Then the revaluation method is the revalued amount or the fair value amount minus the subsequent accumulated depreciation minus impairment losses, accumulated impairment losses.
Correct. That's all. Don't say more than that. That gives you 3 marks. Don't start explaining unnecessary things. So they said, okay, what's the machine cost? It's just what we have done. We have already done this together. Is 578, gives 3 marks. What's the revenue expenditure? All those items you did not capitalize here. You expense them. You just come and expense everything. Right? That maintenance contract that was 4 years, you squared it over 4 years. Then the only thing you need to calculate is your depreciation. And that's what they want you to do in the third part, where they say we should calculate carrying amount. So what they want us to do there, we already know the costs, then just calculate depreciation, you get carrying amount. So how do you calculate carrying amount? In year one, at the end of year one, the cost is 578,000. The residual value is 90. Depreciable amount is 488. Sabi, where did we get the residual value? This is it, 90. So my depreciation, since depreciation was given in units, that's you get the production for the year over the total production times depreciable amount. I showed you an example of them. So it gives nice 97,600. That's the depreciation for the year. And this is how I got my production for the first year, 1,000 this year. Now, my carrying amount is simply my costs minus accumulated depreciation, which is this. So another mistake students can make is to calculate carrying amount as this one, depreciable amount minus depreciation. That would be very wrong. So this depreciable amount is sole purpose in life is to help you determine your depreciation because that is what you depreciate. When you want to get your carrying amount, is always costs minus depreciation. That's your carrying amount. Now, when you establish that, in year two, you know that, okay, from year one, my carrying amount is this. So I brought it forward. There was a subsequent cost of 300. There was a subsequent cost of 300 from the correction that we said we should capitalize. And they also said they revised the residual value to this. So this is now my depreciable amount. This is the new carrying amount as at the end of the second year. And don't forget that because of these additional costs, our useful life has changed from 5,000 to 8,000. However, what was the production for that year? You find out that the production for that year is 1.2, right? But how come? How did I move to 2.4? Why did I take 1.2 to 2.4? Can anybody help with that?
The previous 1,000, you added it to the New Year's unit.
The previous, if I add it, that's 2.2 now. Doesn't give 2.4. Femi,
I
can you help?
stated in the question.
Sorry?
I think it was stated in the question.
Lukman, can you help us? Ayo, can you help us?
Sorry, I didn't even hear the question. I had network issues.
Oh, okay. So in year 2, we used 2004 as the unit, but the unit in year 2 was 1.4. I'm asking why. And I know that it's related to the fact that our unit has increased to 8,000 because of this additional cost.
Yes, we even it out because of um the increment we got from the additional this thing that we add to the assets. So
Okay, so how
there
did you
was
take this
increase
to
in the
2.4?
output. Uh, where we check the unit that we had left. So let me go to the unit that we have the initial output.
1,000.
Yes. So when we add the 3,000, if we look at the percentage increment that we have on each one of them, so the remaining 3,000 will be spread across.
Okay, sir, can I try?
Yes, you
So,
can try.
the, estimate, the estimated useful life initially was 5 million. So
Uh,
then after the first year, we're supposed to have 4 million left. So, but after
mhm.
the revaluation, then the output doubled from 4 million to 8 million. So definitely other output is going to double. That's why we have
Fant-
that 1,000, 2.4 and 2.8 and then like that.
Fantastic. Fantastic. That's absolutely correct. Yes. Because initial production, the total output is 5 million. In year 1, yes. When we were doing our depreciation, we did 1,000 over 5,000 times the depreciable amount. But in year 2, they told us that the output is now 8 million. So you know that we don't expect this to remain the same. They will also increase now because the total has increased. But by how many percentage? The examiner knows it's very sensitive. They don't want you to start doing unnecessary calculation. So they only need you to figure out the fact that, okay, this doubled by how much? This 8 million is an increment by how much so that you know how you want to increase this. Fortunately, after year 1, in year 2, the remaining output will have been 4 million. Okay. And now our output has increased to 8 million. That's 100% increase. It's intentional by the examiner. They will not do otherwise in any diet because they don't want you to start doing any funny mathematical calculation to derive this because you have a lot to do with your time. So all you just need to do is just to double each of these two. Since the total doubled, automatically the output for each year would double. I think that was what Lukman was trying to explain, but he didn't remember the way I explained it because it's been a long time anyways. And that's why in year 2, to calculate our depreciation will be based on 24 over 8 million. In year 3, it will be 28 on 8 million. In year 4, it will be 16 on 8 million. Like that, which was what we did. So you see 24 on 8 million, 28 on 8 million, 16 on 8 million, all multiplied by the depreciable amounts, the same amounts that we computed up here. So you can just look through this. It's
Sorry, sir, I have a question.
Okay.
So if peradventure or in a scenario whereby it didn't double or it wasn't doubled, how do we now get the revalued units then?
It's not
Probably
difficult.
that
It's not difficult. That was what I was telling you, that the examiner will not behave that, they will not give you that. But even if they did, let's say they said it's 6 million. Even if they said 6 million, so that means it increased from 4 million to 6 million. That means you need to do the percentage increase, which is 2 over 6. Will give you the percentage increase. So what's the percentage increase there? If you do 2 over 6, that's like 33.33%. So just multiply 1.2 times 1.33, 1,400 times 1.33, 800 times 1.33. Will give you the percent. No, 1.33. Yes, 1.333. Multiply each of them. Will give you the new units because they will also increase by that 33%. But I bet you they will not. That was why they give you 100% from 4 million to 800 to 8 million. So you should know that you need to double each of these guys like that. That's how far they will go. But if they don't, just get the percentage increase in the total. Use it to increase the respective years too.
Yes.
okay, sir.
And there are some other questions here, but just take your time, revise it. They are absolutely straightforward. I've already shown you how to do some. So let me just show you this one more question, and I will leave this particular one. So if you look at this question, it says a property was purchased on 1st January 2000 for 2 million. They said estimated depreciable amount 1 million. Useful economic life 50 years. Annual depreciation 20,000. Was charged from 2000 to 2004 inclusive. And on 4 January 2005, the carrying amount of the property was 1.9. The property was evaluated to 2.8 on 4 January 2005. Estimated depreciable amount 1.35. Useful lives remain unchanged. Show the treatment of evaluation surplus and compute the annual depreciation charge. Okay, so if you look at this, so they bought the assets in January 2000 for 2 million. They already told us that the depreciable amount here is 1 million. For whatever reasons, probably maybe the residual value too is 1 million, whatever. But they told me the depreciable amount is 1 million, useful life is 50. That means this 20,000 depreciation they gave you is simply 1 million divided by 50. That's this depreciation. And this depreciation of 20, they charge from 2000 to 2004. That's 5 years. 2000, 2001, 2002, 2003, 2004. 5 years. That means I've charged depreciation of 100,000 so far. Fine. You know that if they have charged depreciation of 100,000 so far, do you know what the carrying amount would be at the end of 2004? That's 2 million minus 100,000. That's 1.9. Abi?
Yes.
Good. Good. Now, let's say that on January 2005, the carrying value of this property is how much? 1.9. They have given us that 1.9. They said they now revalue these assets to 2.8 million on 4 January 2005. Right? And anytime they revalue, anytime an examiner tells you they have revalued, you see, at the date of revaluation, determine depreciation, determine evaluation surplus or deficit. Luckily for you, the date of revaluation is 1st of January. So that means you don't even need to worry about depreciation for that year. The first thing you need to worry about is the revaluation. If this asset was revalued at the end of the year, and that's when you need to worry about depreciation for that year before you determine evaluation. But in this case, the evaluation was done at the beginning. Depreciation is done at the end. So at that 4 January 2005, I will determine my evaluation surplus or deficit, which is, like I told you, is the carrying amount. In this case, is 1.9 compared to my revalued amount, in this case, 2.8. My evaluation surplus is 900. You see, this revaluation surplus should go straight to where? OCI, because there is no previous revaluation deficit. However, don't forget I told you something about evaluation surplus transfer. When you transfer from evaluation surplus to retained earnings, and I told you that this is computed as evaluation surplus all upon the remaining useful life. In this case, evaluation surplus is 900. Remaining useful life is 45 years. Okay, when you do 900 over 45, it gives us how much? 20. I told you that this is optional. You only do this when it is required by the examiner. In this question now, you don't do it. But if the examiner says it's the company's policy to transfer revaluation surplus to retained earnings, that is when you do this. So you will see I didn't mention it. Now, having determined your revaluation, then you can then get your annual depreciation, which is the depreciable amount, like they gave us here, divided by the remaining useful life, which is 30. So in 2005, my carrying amount is simply the revalued amount minus the subsequent accumulated depreciation, which is 30, and that gives us this. So as a follow-up from the previous question, so I was told that the property referred to in example 1 was now revalued again as at 34 December 2006, and its fair value are now falling to 1.8 million. Compute the revaluation loss and state how it should be treated. Now, in 2006, since they revalued as at the end of the year, as at the end of 2006, so first you need to worry about, okay, what's the carrying amount? Because this is revaluation at the end of the year. Of course, you have computed the annual depreciation year as 30, 30, 30. So the carrying amount for last year was 2770. So carrying amount is just 2770 minus the depreciation for this year. It gives us this. The revalued amount is 1.5 million. You take it away. In this case, now we have a deficit of 1240. So how do you treat these deficits? Ordinarily, deficit should go to P&L, but since there was a previous surplus of 900 here, there was a previous surplus here of 900. So that deficit will go to OCI to net off the surplus. Then we still have extra 340 that you can then take to PRL. You still have extra 340 that you can then take to PRL. And that's how you treat those ones. I have a lot of questions here that actually give you to practice. I have some solution there. Some solutions are not there for you. So you can just look through this as your revision. As your revision. Okay, so I'm going to stop this intensive here. We have already spent 2 hours. Anything beyond 2 hours for an evening class is what Yoruba people call Asheju. So we'll continue this intensive class tomorrow. Then, yeah, you know that this part will take a lot of time. So I can then run you through the other standards. There is 38 financial instruments. But I really want to revise those key things with you like that, just for you to remind, yeah, you. And you can also go through this material at your leisure to ensure you look through it. But let's go through it. Then eventually I would also that will be during the week. I'll find time to for us to at least look at that IFRS 18. But first thing first, I really want to revise this with you, which would give you a strong basis to be able to continue to solve your past questions and also the pilot as it were. All right. Have a wonderful night. I'll see you guys um tomorrow where we'll continue our discussions on this. Bye. See you.
What time tomorrow, sir?
Same time.
Thank you,
Thank
sir.
you very much, sir.